Okay, so we're going to go over market phases now. Market phases comes from originally Wyckoff material of accumulation, distribution, so on. And then we have a level called an automatic rally, automatic support. We'll be looking at that. And also the test. Let's see if we can get all that in here. The low volume test. Okay. So I'm going to run through these phases. Now this, simply looks like a downtrend. We're calling it a markdown phase, but there's ways of determining the phases besides just highs and lows. Volume being a big part of it. So, as we've already seen, imagine this is a 1-hour chart. And at this point, as we know now, this signifies strength and buying, right? That's smart money. Although they didn't do it sooner, at this point, these low prices attracted them to buy. Profit-taking, demand coming in, buying coming in, as we know. So we see that reaction to the high volume off the low price. So that's our typical, as we've seen, stopping volume or climactic volume is really what we're looking at when we're talking about counter trend. That's what we're starting with here. So markdown or downtrend, and we're looking at buyers coming in. It's a good place to start because this does show, it's a little more intricate and it reveals a lot about how smart money operates and gives opportunities to trade. So now we see strength coming in off climactic volume. Now when if you're going counter trend, you do want to see very high volume. If you're going with the trend, not as high as required. We'll see more examples so you really know what you're looking for. Ideally, in this situation, you'd see volume higher than anywhere throughout the trend. But maybe it's not always perfect. Maybe there was a lot of selling, at some point earlier, and so on. But we do want what's called climactic or ultra-high volume if we're going to consider counter trend. And again, that makes sense because if the price is moving down, we want a lot of buyers to come in, a lot of activity at that low price, particularly to tell us that we'd rather be buying. And of course, we don't want to look to sell once we see that. No matter how good this downtrend may appear, all that buying tells us we no longer look to sell. So you can see that volume leads the way still, even though prices, are just making lower lows and lower highs. We see a difference here where we would no longer be looking to sell. Okay. So that's a markdown, switching over into accumulation. So markdown here, and this basically begins the accumulation phase. Understandably, right? The smart money is accumulating long positions. So typically, you're going to get a bounce here, and it's going to create a little resistance level. It's more rare, or less common that you're just going to go up in a straight line. I mean, if you look through your chart, it's constantly zigzagging. So only maybe the aggressive buy entry at this point would get you in if it just kind of shot up quickly, But typically, there's patterns that we can look for and stuff to give us higher probability trades. Let it come to us, be more patient, kind of stuff. Higher probability, more conservative. And we'll see as we go through aggressive versus conservative style entries and how to go about that. So what I want to highlight here is the first level of resistance after the strength. So that's the automatic rally, or the AR, we can call it automatic rally. And that comes from Wyckoff material. So to give it a clear definition, right? Everything I want to make black and white, no question about it. What is it? Define it in a few words, one sentence. So the first level of resistance, that sets up after strength. So here's our strength, price moves up, and at what point are we able to spot this level of resistance? Of course, about here. So as price pulls away, you can even use a 50% marker to say, okay, we've pulled away enough. We've pulled back enough to say we have a resistance. At what point do you say that? So that does help you if you do a fib from this low to high and you see a 50% retracement. So you've lost 50% of the move. You can call that, a resistance. And typically this is an area where they're testing for sellers, so we're going to get into that. And this is an area that's not random as far as after strength, a level of resistance. It's typically not a random level. It's even a level that you could predict ahead of time using tools that we already went over. So, but we'll see examples of that. So First level of resistance after strength is called the automatic rally. At this point in the chart, we can mark that. We can put a line on our charts and mark that. You can even draw a box over the pin area there, right? So we have our level of resistance, automatic rally. We have our strength. Now, again, before I get into the entries, we want to more understand smart money, track them. Okay, so this is a test for sellers. Again, let's make it in this example, which very often happens. Just look at your chart. You'll see this stuff all over the place. That this, as we said earlier, previous support becomes resistance. Here's our previous support as we move along. Very obvious support. And on the bounce off the strength, the automatic rally, the first level of resistance, ends up being that support turned resistance. So we already could have had that line there drawn in advance. You know, maybe it's a previous day's low. Again, it could be a 1 hour chart. Your previous day's low, you break it, you're coming back to that level. Okay, so you know it's usually very obvious. So and again, you see it happen at areas where that could be a previous support. It could also be the daily pivot of the previous day, and so on. So using those tools could be a fib. So using those tools, it could be an upper trend line. So it's very easy to predict. It could be the 50 EMA. That's very common. The 50 EMA on the 1 hour chart, right? It's coming through here. You're moving average. You can draw that in kind of. 50 EMA gets tested there and acts as resistance as well. Very common. So in this case, you're making sense of it. You're saying you're looking at the same potential areas they are for this to occur. So again, you're mapping it out here. So now that that's occurred, the automatic rally, it's an important level going forward as we're in our accumulation phase. So let's continue and show what often happens as price can go into a range here. Now, this is a very common pattern. It doesn't have to do this, and there could be opportunities sooner. But again, this is a common pattern and something that really reveals a lot about how smart money operates. Okay, so now we're testing for sellers. Now, what does that mean, right? Smart money bought here at a low price in large amounts against that selling. Price rebounded, rallied, and that's your resistance that's formed. And they're testing for sellers, meaning that they're pausing their buy activity, which started here in large amounts, pushing it up, right, and pausing their buy activity to test for sellers. Now, why would they do that? You have to think, if you were them, like, think it was you, that you were buying here, and you knew that you were positioning against still selling. It was aggressive in that way where you're basically starting to pick a bottom here in this downtrend. Your only concern as a buyer buying into a downtrend would be what? There's still a lot of selling, right? Smart money isn't so all-powerful that they're constantly manipulating the market 24 hours a day and just swinging price around wherever they want. That's not what's going on. There are times of concentrated, periods of time where they are manipulating and so on, but it's a give and take with what's going on with the rest of the market. So, of course, their concern is if there's a lot of selling, do they want to continue to build these long positions? Do they want to bail out? They need that information. So if you're buying in the market, you want to know what the selling activity is like. So we test for sellers to find out at places that you could predict. Again, this is going to be clean stuff most of the time. If it's not clean, you may want to skip it, or you may have enough other things telling you besides this. But you'll see how good you are at predicting it through using Confluence. So testing for sellers. Now, in this case, we could simply have a very low volume, small move, and then continue up. But in this case, I want to show a little more activity and understand. So we test for sellers, and what happens here? We've come back to the previous support. Real simple. Always be aware of support resistance, and we're coming back to test that support. Now, this indicates to us, as buyers or potential buyers, that there is a moderate, still, a decent amount of activity to the sell side. There's selling coming in still. We didn't, go shoot up in a straight line of complete lack of selling. We didn't do a small low volume test and continue. It didn't do a fib retracement and continue. This signifies to us, if it can double bottom, there's still some active selling, okay? So you're a buyer, and testing for sellers here, you'd be patiently waiting to see how this stuff is occurring. Now, one thing I want to point out here is the volume. So let's make that sort of medium volume there, and that represents a good, healthy situation where we can still look to buy. Now, I just want to show the alternative where, let's say this automatic rally set up on high volume. Okay, so maybe you had this to start, but you got this next piece of information. Here's the automatic rally, and it's setting up on a high volume. Well, we know the principle. Higher prices getting rejected on high volume and coming down and creating resistance is a sign of smart money selling in large amounts. So if you see something like that, that would tell you there's not a consensus among smart money, and basically something we've got to start focusing on here is the balance of supply and demand. So as we test, we find out, and we're looking at the balance of supply and demand, sellers and buyers. Demand is buyers, sellers is supply. Supply is sellers. We just use those terms. So we've borrowed a lot of terms from here and there. So again, demand, right? Buyers become very active here. And the test for sellers, we'd like to see low volume, medium volume. If we see high volume, again, it's that same principle. We're not inventing anything new. Now we're just starting to combine these tools to understand things. And we see higher prices getting rejected on high volume. Okay, that rejection on high volume is telling us selling is still very active. Maybe, and price is likely to continue if you see that situation. At least what we want to say is it's not a opportunity to buy if that occurs. Okay. So, on the other hand, you could have low volume there, particularly low, and that's a good sign. That's really tells you as a buyer, and low volume on this as it comes off of this area, generally just lower, So you get a sense. Okay, we're still talking about concepts, reading the chart, reading the buyers and sellers, the activity of smart money, the balance of supply and demand, and honing in on those imbalances. So in this case, we see an imbalance in supply and demand. Large amount of demand, small amount of supply. If there's a balance in supply and demand, then it's not a high probability move. Okay, the more imbalance, the better. Lots of buyers, very little sellers, price is going to go up. Okay, so imbalance here. And in this case, though, let's say there's enough sell activity to bring it down and test this support again. What would we want to see? Now, a concept that I have discovered is the sustained versus the temporary accumulation, or buying and selling. In this case, buying. So if price comes down to this level, what do we want to see ideally to still look to buy and still consider this long situation, or to still consider this accumulation phase and have volume agree with that, saying that smart money is buying? What do we need to see? An increase in volume. That doesn't have to be ultra high. It's typically not going to be as high as the first volume most of the time. It's going to look something like this most of the time, like that. This is a good, healthy, regular situation. So it could be higher, but I like to see the increase there. And, of course, the rejection. So that shows the same concept again. Lower prices, in this case, support, attracting buyers. Higher volume, and a bullish reaction. Right, the result. Very often you get a fake breakout pattern. So a little below that support. And if you do get a fake breakout and you actually break that, again, you want to see the higher volume and the low price. And what confirms a fake breakout? You get a candle close back inside the range. Whether it's a 1 hour chart or a 5 minute, we're saying this is a 1 hour chart. So for our overview and direction of where we're looking for trades on smaller time frames, breaking here, we want to wait. Closing back inside the range, let's say a 1 hour close back above that support, rejecting on high volume off of that fake breakout. Now we've confirmed the fake breakout by closing back inside the range. So very often that'll happen as a good sign that the lower prices attracted buyers, right? But the fake breakout pattern is something that we're going to see consistently. And, if If you haven't noticed it, it's all over the place. You can see it every day, and just like fib retracement stuff. So it's really that common. It's part of the routine. Maybe half my setups have that, or just it's so common that the last thing you want to do is take a breakout. And you can imagine what goes on here. Understand that. What goes on here on these fake breakouts? Well, first of all, this is selling a breakout late in the trend. So it still appears to be a downtrend, right? And you're selling the low price on a breakout in the direction of a trend that's already been established. This is not the way I trade. I don't take breakouts like that. So why? Principle number one, lower prices tend to attract buyers. And we don't know what's going to happen down there. Maybe if there was not buying shown here, I can look to sell a retracement. But particularly buying shown and going into new ground, we don't know what buy orders, lower prices attract buyers. Okay, maybe. We just don't know. It's not. It's too unknown down there. So that's not the way smart money does it. We're a step behind if we do that. So to understand that concept, and traders that are taking that breakout, again, I went into the trade, and it went right against me. I don't know what I did. I traded with the trend. I got a signal. I got an arrow. I entered, and bam, it just reversed. Right? So that kind of stuff is what's going on. Now, breakout trade, now the lower prices attract buyers. So it gives smart money an opportunity to buy in large amounts at an even lower price. Why? Because the herd is selling. That could be bad news. Which is something we'll get into talking about news. That could be bad news. Price makes a new low, breaking the low of the day on bad news. And there's a lot of selling. That gives the opportunity, if smart money chooses to, for them to step in and buy in very large amounts. Remember, smart money is trading in such large amounts that price is going to move in the direction they're trying to enter, and they're not going to be able to be hidden, and they're going to get bad prices. Imagine you went to buy milk, right, and it was on sale. And as you're paying for one and then paying for the next, and you're buying 5 of them, the price keeps going up. You're marking up price. That's how much they're affecting the markets, right? So they don't want to do that. They want to buy at a low price. So if there's a lot of selling, say on a breakout in the direction of the trend, maybe on bad news, they can buy a lot down there. There's a lot available for sale. There's a lot of selling. So they get a nice low price. I really want to get these concepts, into your head. So it also tends to hit a stop loss on anyone who's long here, right? And the fake breakout hits their stop loss, which comes in as a sell. They're selling their position that they bought. So again, a lot of selling comes in. Smart money can buy it right up. So you see that pattern, and you know what occurred there. On a side note, if you're going long off of a support or a fib or whatever, leave room for the fake breakout. Don't get caught by that. Typically, we're talking 5 to 10 pips, but we'll cover that stuff once we get more into entries and stop management and all that stuff. But you do want to be aware of how often this occurs and not get caught on a fake breakout, hitting your stop loss, and then watching the trade go without you, right? I learned that the hard way, so save you the trouble. All right, so hopefully we get the concepts, understanding the test here, understanding that we're seeing, as I said, sustained buying off of the support level now. It's becoming a double bottom fake break, and we're seeing sustained, meaning, continued buying versus temporary. So again, if volume did not increase here, and we saw a candle close below or coming below the support, and this is a 1-hour chart, maybe we've seen the smaller time frames more detail, which we'll get into, and not seeing any buying coming in, not seeing the volume coming in showing buyers, that's going to tend to continue. So if it's going to test that level, again, we get this information off of these levels, really know what's going on. So we do see that proper reaction. Okay. So we can continue to call this accumulation. It's still a situation where we expect the breakout to be to the upside. Okay. So we get a sense of where we'd want to, which direction we're trading, obviously, and we'll get into entries, Now, once the 1-hour analysis is done, then you can smaller time frame for that. So we'll get to that soon. Okay, so now let's just continue with the phases. That this is accumulation phase. Smart money has bought and positioned long, and this breaking of the automatic rally, price moves above it, is attempting to go into the markup phase, the uptrend. Okay, so this marks a point at which we're switching over. So this is a concept that, this is something I discovered. I pieced it together from some information that was out there, but again, I like this black and white stuff, simplifying, getting down to the point. Okay, smart money works in two ways. There's two ways in which they enter the market. Not three, not one, and they're night and day. They're black and white. So, we're talking about a big entity, bank, how they would do their activity throughout this situation. Okay. Way one. We've talked about that a lot now. So buying into down moves. Okay. Positioning long. Buying in a way that does not mark up price. They're not creating an uptrend yet. They're pre-positioning, anticipating the move is coming later. That's way one. Second way. They're entering in a way which intentionally marks up the price. When they buy, they want the price to go up. When they buy here, they want to try to buy low, stay hidden. They're not trying to create uptrends yet. Momentum, highs and lows, whatever you want to call it. They want those low prices. In this case, they're entering in a way to help now this is making a lot of sense, because if they're positioned long here, they want to try to push that now that they've gone into the uptrend finally here. They want to push it as much as possible. It's in their best interest to do that, obviously, right? So this is really how to maximize, pulling money out of the market, right? You're not manipulating every move, but you're working this market to make the most money, right? So this is what they're doing. So, people say they're greedy or whatever. This is just the proper way to work any market, understanding supply and demand, the imbalances. So pre-positioning is way one. Way two is the marking up or marking down of price intentionally. So they enter long and they want it to go up. Okay. So this marks the switch over from that way one to the second way. This is the switch over, the break of the automatic rally. Okay. So this marks the computers, right, switching from buying and matching sell orders to pushing price up, testing for sellers, not seeing many. Okay, going for it, pushing it again further, pushing it up to a resistance, pausing, testing at that resistance, seeing a lack of sellers, or seeing some selling, maybe they'll buy into the down movement, and so on. So we're into the markup here at this point officially. Now, just to point out reality here, the variations that can occur. I'm not going to just show you this one clean way. The point is the tools work, What if you see high volume there off a high price and there's a bearish reaction, right? What does that tell you? That the markup is likely to fail. So higher prices attracted sellers, right? We tried to break out, but the volume was high and we came back in. That really closes the deal, right? So in this case, we expect the markup to fail. We expect it's probably going to go lower. Maybe these buyers are going to bail out, and this is going to continue down, right? But we're not getting caught here. We're still up high. If you've bought in this area, which is where we're looking to mainly buy, either the bottom of accumulation range or further on in this area after a proper test or whatever. So as far as entries, we're not getting caught out there. But if we're seeing this break out here on high volume and getting rejected as a result, and really, again, what closes the deal and signifies a failed markup is coming back below the automatic rally as a result of that. So again, higher prices attracted sellers, right? Same thing. And we also have a fake breakout pattern. Again, the resistance, it broke, and it closed back inside the range to confirm that it's a fake breakout. Fake breakout on high volume, we just saw that here to create the bounce, right? We just saw that showed buying. So this, it could be representative of a lack of consensus among smart money, a change in sentiment, but it's not representing a high probability trend up, of course, at that point, and it could even create ranging conditions. See buyers active here, sellers active here, and range could continue for a while, which is tradable. We'll cover that. So just wanted to show, the tools work for variations. So to get through and end this segment, we've now gone into a markup phase, and we can look for opportunities to buy, particularly most common for me on the retracements. This could be fib, confluence, and we'll get into the details of those setups. And typically that's where I'm looking to trade. There are other types of opportunities, but this is the most common and high probability stuff is what we're going to get into on these entries. So that's the markup phase. And again, you expect that to continue until we see weakness. If we saw a lot of selling here, we would not continue to look to buy. So keep in mind the health of the trend, particularly at those higher points. If that's rejected on some medium volume and it pulls back in this high volume rejection there, it's likely to continue. We see buying into the down move still. And we don't see higher prices attracting sellers, or do we, right? So we get to judge the health of that markup as it goes, see if we expect it to continue, and look for our entries or not. Now, last thing to mention about the phases is this is reaccumulation, again, up during the markup, and this is redistribution. Now, distribution is basically the opposite of accumulation. So, we're up here, we're seeing high volume, and smart money selling, building up sell positions over time. Supply coming in is also what it's known as, selling, supply coming in. So high prices, you can see some high volume. You may go into a range, or you may reverse the trend from there. And, that's distribution. So accumulation, distribution, markup, markdown. And again, these retracement points during trends, uptrend, markup, retracement points that attract buyers during an uptrend is reaccumulation. Reaccumulation. Redistribution, redistribution would be selling during the trend into the up moves. Okay. So we are done with that segment, and we're going to get deeper and deeper into it, more details, and eventually get to our entries. Let's move on.